Hi, John. I mean, it is a path that is sort of in the middle of that. I think Powell today was kind of emphasizing that the Fed's reaction is changing, and that's why we saw March and May hikes actually increase. But if you ask, is the trajectory of inflation what changed today or moved markets? It hasn't. In fact, if you look at the break evens for 6 months forward or 12 months, they actually went down today. So I think the stock market is going to care about the path of inflation. It does care about how the Fed reacts to it. But the reason we're constructive has a lot to do with leading indicators showing us that inflation could be a lot softer. I know January sort of changed a lot of people's minds, but we start to get some of the February data, and I do think some of this seasonal distortion, the gap between jolts, and indeed, I mean, these gaps as they close actually show us that inflationary pressures could be easing actually a lot faster than expected. So that's keeping us constructive.
So, Tom, then, on a day like today, and I know you're bullish and you do think the market's going to rally, on a day like today where you have all the major averages down more than 1%, every sector in the S&P in the red, would you be buying, and if so, what?
Yeah, I mean, today's a day that, someone hits the sell button and maybe not discriminating on price. So I would look at that as a buying opportunity. I mean, the VIX moved up, but the 10-year yield actually was pretty flat. And we did see some signs of panic, whether you're looking at ARMS index, it's not quite at the panic level, or the put-call ratio. So I do think that this is a better entry point, not to be selling here, but to be buying. And, we'd be sticking with what we liked at the start of the year, which is FANG and the industrials. And then sort of a distant third is energy. But energy is probably tougher in the first half.
Mike, want to get your thoughts on this, too, because we did see broad-based selling today. Financials, the worst performing, real estate, as you might expect, with yields moving higher as well, but also materials. I mean, it was really kind of across the board today. The way to think about this, just a knee-jerk reaction to what we saw in the bond market in response to Powell or something more in terms of the technicals?
I think it was mostly a reflex response, but a justified one to a fair degree. I mean, you have to reprice according to the rate path. I do think breadth was relatively negative, but it's, we're working off of, I think, some money in the bank, so to speak, that the rally has earned us. So it's not as if you've kind of unwound the strength, even of last week's bounce. So technically, I think it's okay. It's precarious, but it's probably not something that changed. The real weakness in regional bank stocks within financials, definitely noteworthy. If you look at like a 5-year chart of the regional banks ETF, it looks like it's kind of teetering near the edge of some key levels. Basically, it hasn't been this low in a couple of years. So, that's not a great economic message, but you've also had head fakes lower before in exactly that sector.
Tom, would a 50 basis point hike change your opinion?
I mean, 50 basis point hike is going to have to get priced into the stock market. I think today was maybe the start of how that's going to affect markets. But, I think there's a misconception that as long as the Fed is hiking, that the stock market will go down because financial conditions are tightening. I mean, that was true of last year because the Fed was higher in a hurry. But if you look at the 14 Fed cycles since 1970, where the Fed was raising over more than a 24-month period, 11 of those 14 times stocks made new highs while the Fed was hiking.
So what would it take? I'm wondering, what would it take? 75? Would it take just a 7% target? What would it take to make you less bullish?
John, I think if we were hurtling towards a recession, I think that would be tough for stocks to actually rise. But as you know, there were predictions of recessions last year. And again, we're still waiting for those recession, metrics to show up. So I think as long as inflation is improving and the Fed is doing its job, that's not a reason for someone to say the stock market has to go down 20%. Last year, we already had a 27% drawdown. So I think, you have to keep in mind the market's been in an uptrend since October. So we're 6 months into an uptrend. And if we pass this test and we're up 5% this year, is someone going to say, where's the recession? Or are we going to say that maybe it was a time to be adding risk?